Hi, my name's Claire Gallagher. I'm one of the tutors here at Tolley Exam Training, and I'm going to run through a session to talk you through some of the questions you may have seen on ATT Paper 1 pre-revision mock. Now, what we're going to do in this session is have a look at some of the short form questions and have a look at some of the long form questions in terms of where would you start, how would you piece it all together. So let's turn to our short form questions first. Now, I'm not going to go through all of them. I'm just proposing to go through the ones that I believe may have caused you a few issues. So I just want to very quickly touch on question number 2. Now, I'm not proposing to go through this question in full. All I just want to mention here with question number 2 is it did test that starting rate band for savings income. So remember, if you do actually end up using your personal allowance against your non-savings income and you wipe out that column perhaps, if the first income that you're actually taxing is savings income, remember you do have that 10% tax rate for the first £2,710 that falls within that savings income. But it's only if that income is the first income that you come to tax. So that's what question 2 wanted to test you on. I just wanted to bring that to your attention. Now, the first question I will go through in full detail is question number 5, because it's a very new topic for us in terms of the 2012-13 syllabus, and this is the child benefit tax charge. Now, if we have a look at question number 5, we're told Wendy and Simon are married with 2 children, aged 7 and 9. Simon earns $48,000 a year, Wendy earns $22,000. Simon also receives $6,000 rental income. Now, if we have a look at what Simon's earning in total, therefore, he's got $54,000. Now, we're told Wendy claims the child benefit, and then the question is asking us to calculate the income child benefit charge for 2012-13, state who is liable for the charge and how it will be paid. Now, just remember, if there's easy parts in your requirement that you can jot down, do them first of all. Don't wait until you've actually done the calculation to give perhaps a due date. So the question here is asking us to calculate the charge, but it's also asking us to state who will be liable and how it will be paid. Now, the child benefit tax charges are always paid through our self-assessment. So that's an easy part of the question that we could jot down. And who will be liable? Well, although Wendy is the person that is claiming the child benefit, this tax charge is going to be based on the higher earner. So it's Simon who will be liable because it's his income that we're going to be looking at in terms of this tax. Now, as I say, this is a new area of the syllabus, and what we're looking for is one individual earning over £50,000. So we're not considering joint income. It's not like child tax credit. This is individually. Now, this means we could have a couple that perhaps both of them earn $30,000. Well, this won't be relevant. So you could have a couple where they both earn $30,000, $60,000 in total. They're not going to be liable to this child benefit tax charge. It's when one of the individuals earns more than 50, that's where we have to do this tax charge. Now, page 3 of your ATT tax tables are very useful here. At the top, we have a child benefit section, which tells us for the first child, you're going to get paid £20.30 per week, and for each subsequent child, you're going to get £13.40. So what we can do here is work out how much they'd actually receive. So we've got that £20.30 for the first child and £13.40 for the second. And then we need to look at for how many weeks. Now, be careful. This only kicks in from the 7th of January 2013. It does state this in the notes on the tax tables. This means if we're doing a calculation for the 2012-13 tax year, we're only going to be looking at 13 weeks, and a lot of students seem to be missing that. So we need to look at how much they're entitled to receive. So if I just tally that up, I get £438. So that's what they can actually receive. However, as mentioned, if one of their incomes is above the £50,000, then we're going to have this restriction. So what we need to do in terms of the restriction is look at how much above the £50,000 they actually are. So Simon, as we say, his income is £54,000. If we take off the £50,000 threshold, we're left with £4,000. Now we then need to look at how many full 100s he is over the 50,000. So if we divide by 100, we get 40. And then we times that by 1%. So basically, you're going to pay a tax charge of 1% for every £100 you are above that threshold. So we're going to have a tax charge of 40%. So what that means is, yes, okay, they can receive, so Wendy, who's claiming it, she can receive £438 for the 2012-13 tax year. However, Simon will have to pay 40% tax, which will equate to £175. Now that will just be included as a separate line within the tax liability calculation, and like we say, this will be paid through his self-assessment tax return, even though it's Wendy that's actually claiming the benefit. Okay, so remember your tax tables are there to help. It does give away quite a lot of the information. It's giving you the weekly rates. It's telling you the 50,000 threshold. It's also telling you about the 1% charge. And the most important thing, that it's from the 7th of January 2013. Now let's have a look at another short form question. So let's have a look at question number 7, which is a question to do with leases. Now, leases can be tested in all different ways. So let's just start with the basics. If we have a look through what they actually require us to do. So we've got Christian acquires a freehold office building for £200,000. He grants a 20-year lease on the building on the 1st of January 13. And Brian, the tenant, pays a premium of £160,000. The reversion is valued at £250,000 in January 13, and we are asked to calculate the chargeable amount to income tax and also the amount chargeable to capital gains tax. Now, there's a few things here that we just need to recognise as we read through the question. So first things first, if he is granting a 20-year lease, that is, of course, a short lease because it's less than 50 years. That's going to be very important, as we'll see in a second. Now, he's also paying a premium of $160, and then a big alarm bells go off because they're telling us what the freehold reversion value is, which means part disposal. So if we're ever told the market value of the reversion, that's generally saying part disposal, but hopefully you would have recognised that anyhow. So let's just point out how we would recognise this by running through a few key points to do with leases before we make a start. Now, if we ever grant a short lease, remember the premium that you receive is always going to be split into an income element and a capital element. So if we take the $160,000 from the question, part of this is going to be taxed in terms of income, and part of it is going to be capital. Now, this is where, to strip out the capital element, we do our 2% times the number of years, deduct 1, times by that premium. And of course, if we're trying to find the income element, well, once we strip the capital element out, we would be left with our income element. So first things first, let's just do that calculation in terms of question number 7. So as soon as we've got this premium, we need to say, well, how much of this premium that relates to a short lease, because we only do this for premiums for short leases, how much relates to income, how much to capital? So let's strip out the capital elements. We're looking at a 20-year lease, so 20 take away 1, and we put our premium there back in. So that's going to leave us with £99,200. And what that's giving us is the amount chargeable as income. So that's the figure we've got there. And what we have just stripped out, that was our capital element. So this is liable to income tax. Now, if we just look at the gain side of this question, we obviously have 5 different alternatives. When it comes to working out gains on leases, you've basically got to look at, is it a sale of a lease or is it the grant of a lease? And then you need to look at, what are you actually granting? So if it's the grant of a lease, are you granting a long lease out of a long lease? Are you granting a short out of a long? Or are you granting a short out of a short? Now what we have in question number 7 is we're granting a short lease because it's 20 years, but we're actually granting it out as a freehold. Now if we're granting it out of a freehold, it's still treated as though we're granting out of a long lease. So this is going to be a part disposal, and that's the best way to remember. If you're doing a grant, the general rule is you've got a part disposal. If you were doing a sale, then you're going to have a normal full disposal with just proceeds less cost. So a short out of a freehold or a long lease means we're going to have this part disposal, and as with all part disposals, we have a lovely diagonal going through our calculation. So what we're going to do here is we're going to start with our proceeds being the premium that's chargeable for capital gains tax purposes. So we'll take our capital element of the lease, which we've calculated to be £60,800. And then this is the fun bit, because what we're then doing is taking our cost, which we were told was £200,000, and then because it's a part disposal calc, what we put in the top there for proceeds is going to go in the top of the fraction. It's also going to go in the bottom of the fraction. So we have that nice diagonal. Now what we also need to do, of course, is put the market value of the reversion in there. So we'll add that in. They gave that to us in the question. So that was the 250,000. But what we mustn't forget, and this is a key point here, we need to put the full premium in the bottom here. Now it's up to you how you want to show this. I personally like to do my part disposals where what I put in as my proceeds goes all the way through in a diagonal. However, what I do need to remember is to come back and put the amount that I've chargeable to income tax in there, so 99,200. Now what you might decide to do instead is just use 160. Entirely up to you. But like I say, I personally prefer to do it this way because it's that nice diagonal all the way through. So we were given a little nudge in the question because they told us the market value of the reversion, which does remind me it's part disposal. I need to do something with that 250,000. And what it then enables me to do is apportion that cost. So I get to deduct £29,659, and then it brings me down to my actual gain of £31,141. Okay, and just to run back to the question and double check the requirement, we were asked to calculate the amount chargeable to income tax. So we did that first of all by stripping out the capital element, and then secondly we were asked to calculate the amount chargeable to capital gains tax. So we needed to put the capital in for our proceeds, do the part disposal count, but just remember the full premium needs to go on the bottom there. Now, if some of you are getting confused in terms of when you would use your lease percentage table, we obviously have our lease percentage tables on page 6. The lease percentage tables are purely used when we have the grant of a short lease out of a short lease or the sale of a short lease. So everything in that question has to be around a short lease for us to pick up page 6 of our tax tables and use those lease percentage tables. Okay, so let's go back to our short form question paper and just have a quick look at question number 8. Now, question 8, again, I thought it's worthwhile just having a look at this question, especially in terms of what you're actually given in the exam on your tax tables. So, question 8, we've got Bert, who is 73, is married to Mabel, who is 80. They have been married for many years. His only source of income is a state pension of $6,000 and a pension from his former employer. Mabel has a state pension of $4,500. Now, before you get carried away calculating things, always check the requirement to see exactly what they want you to do. So we're told to show the calculation of Bert's income tax liability. Now, the reason I have chosen this question to run through is because if they're asking you for the income tax liability, they're not asking you to go as far as calculating tax deducted at source. If they wanted you to deduct tax deducted at source, they would ask you for the tax due or the tax payable. So where they're specifically saying tax liability, that's where we need to stop earlier on. So we're going to run our income through the tax bands, consider any tax reducers, and then we stop where we are. Now, if I just go back to the question, now I know what I'm actually looking for. It's all about Bert, so I'm not going to be calculating anything for Mabel. Now, Bert is 73, so if I glance at my tax tables, I can see there that Bert is going to be entitled to the older person's personal allowance of £10,500. Now, he's married. Alarm bells go off. He's married. What do I need to consider? Well, I need to consider the married couple's allowance. So the married couple's allowance does come with that note 3 on the tax tables that reminds you it's only available where at least one partner was born before the 6th of April 1935. So this means we need to have somebody who is older, at least 78. So Mabel is 80, she ticks the box. So it's not just based on Bert here, we just need to have Bert married to somebody who was born before the 6th of April 1935. So Bert could have been 20, he would still qualify for married couples age allowance. So that's why we're told Mabel's age, and then we're told about their income sources because sometimes we base the married couples allowance in terms of who is going to receive it. It's sometimes given to the person with the highest income. Now, actually, this will change when they introduce the civil partnerships because with civil partnerships, they then said we'll give it to the highest earner. Before civil partnerships, it would always go to the husband. Now, we're told they've been married for many years, so we're going to go on the assumption that it will always go to the husband, but even if that wasn't the case, it would have gone to the higher earner anyway. So either way, Bert's the one that's going to get this married couple's age allowance. So let's have a look at his income in terms of calculating this. So first things first, we need to look at his personal age allowance. Now, if we just jot down the types of income we're looking at, because remember, there's also that rule, again, it's the fourth line down where we see reliefs on the tax tables that says £25,400. Now, although people who are 65 and above can receive that older person's personal allowance, it's only if they're not earning a reasonable amount. And what we deem a reasonable amount to be is £25,400. Now, if we have a look at Bert's income, he has those two pensions. He's got £6,000 and he's got £21,000. So he's actually earning £27,000, which is above that £25,400. So the revenue believes this is reasonable. He's earning, therefore, above a reasonable amount. So where they wanted to give him the personal allowance of £10,500, they are going to restrict it. So what we're going to be looking at is restricting it because he's earning above that £25,400. So let's show that in a separate working. So our working would show he's actually above that £25,400 by £1,600. Now we take half of that excess, so it's not the full amount over, it's half of the excess, and that's what we're going to reduce his personal allowance by. So although we're saying you're still entitled to a bigger personal allowance, the revenue aren't going to give as much help because they feel he earns a reasonable amount. So the $9,700, this is our revised personal allowance. Now the question has asked us to calculate his income tax liability. So all I've done so far is worked out his personal allowance. And remember, if he'd earned a bit more, it would have meant I obviously would have had to bring down that $10,500 by more, but I can only actually bring it down to the £8,105. I can't penalise somebody just because they're older. They can't end up in a worse situation. And of course, the only time we can actually restrict the £8,105 is if we have somebody that's earning over $100,000. Now, also just be careful, because it's not just the income we're looking at. We do deduct, of course, gross gift aid, personal pension contributions. So we do look at adjusted net income, although this wasn't an issue here for question number 8 and Bert. So let's go back to what we would normally show. So if I was doing his tax liability calculation, I would show his pensions in his non-savings column, which, as we've discussed, is $27,000. Now I'm then going to deduct his personal allowance, which we've just calculated. So we would do a little working to show where we pick that up from. So remember, always label your working. So it might be that I've shown that there, working number 2. And then that brings me down to his taxable income. And the taxable income will therefore be $17,300. Now, this is all non-savings income. So when we come to tax this, we're going to tax it all at 20%, which gives us £3,460. That would normally be our tax liability, but remember, we always need to consider tax reducers to give us our full tax liability. Now, tax reducers, married couples age allowance is one of those. And again, use your tax tables. So where we're looking at married couples age allowance, we're taking that figure off the tax tables of £7,705. We're taking 10% of that, which means we can reduce his tax liability down to 2689. And that is where we would finish. Now, we weren't actually told about any income tax at source, so perhaps you wouldn't have considered that, but if you were perhaps given some tax deducted at source, you wouldn't deduct it. If you had gone further, you just wouldn't have got any credit for that, and of course it's wasting your time. Now, in terms of this married couples age allowance calculation, it could have been worse. So do remember that if perhaps you've had to cap your personal allowance at 8,105, perhaps you wanted to bring it down by a larger restriction, but like I said, we can't actually penalise them for being older, so they still get the 8,105, but if we did have that excess restriction, we would of course have used it against the married couple's age allowance. Now again, the tax tables are great because it also reminds you that there's a minimum. So as long as you're married to somebody who was born before the 6th of April 1935, you will always get some form of tax reducer. And the minimum it would be the 2960 at 10%. So that's something perhaps they could have tested to make this slightly more difficult. Okay, so that's question 8 considered. Now let's just jump, and the others I thought were reasonably straightforward. So what I would like to just spend a little time looking at is question number 15, which was payments on account. Now, payments on account is something that's quite important for you to get your head round because it can appear on paper 1, it can appear on paper 2, and depending on your optional paper, it could perhaps appear there as well. So let's just have a look through question 15. It was worth 4 marks. And payments on account could also sit at the end of perhaps a long form question. So let's make sure we're happy with these. Now, a few things just to bear in mind. Before I have a look at all of these details, I'm just going to have a look at the requirements first to make sure I know what I'm looking out for. So we're told to calculate for Mr. Edwards the tax liabilities that he should pay on the 31st of July 13 and the 31st of January 2014. Now, what I think we'll do just to help you with this is have a look at some of the dates on a timeline. So let's just work out exactly what those dates represent. Now, if I work backwards, so let's put the 31st of Jan 14 in there at the end. So by working backwards, think about it logically. When the tax year finishes, so let's say the tax year has finished on the 5th of April 13, we then have to wait those 10 months, and then we're filing our return if we're doing it online, and we're making our balancing payments. So that tax year has finished, and that of course is the end of 2012-13. So what we've got here is the 2012-13 balancing payments. Okay, so that's what they're asking us to calculate here. Now remember, we don't just make balancing payments, we also have to consider payments on account. These take place on the 31st of January and the 31st of July each year. So let's just work our way back a bit further, because July, so let's pop July in there. So July 13 would have been a payment on account, and that payment on account again would have been towards that 2012-13 tax year. Now if you're getting confused by this, let me just put the previous filing dates in. So if we think about January 13, that would have been the balancing payment for the 2011-12 tax year, and then on that day we would have made a payment on account towards 2012-13, and then 6 months later we would have made the same payment on account again for 2012-13. So these two figures here, as long as you haven't made any reductions, those should be exactly the same. And we base those on 50% of the previous balancing payments. Now remember, you're making these advance payments of tax on the basis that you're going to earn exactly the same amount in the next year. So back on the 31st of January 13, they would have looked at their balancing payment, how much they had to pay over for income tax and Class 4 national insurance, and then they would have taken 50% of that figure and paid it up front on the same day towards 2012-13. 6 months later, they're going to pay over the same figure. So by the time they get to the 31st of January 2014, they've already made these two payments on account, and if they were to earn exactly the same amount the following year, they would actually clear their tax. They wouldn't have anything left to pay. So what we're actually asked for in the question is we're asked to consider what would be paid here, but also what would be paid here at the end of January. And what we also need to appreciate, of course, is we'd have a payment on account going forward for the next tax year as well. Okay, so let's have a look. Let's go back to the numbers. Now we're told we've got Mr. Edwards, who's a new client who's confused about the amount of tax he has to pay and when. His tax liabilities for the year to the 5th of April 12. Okay, so let's make this easier. That's the 11-12 tax year were as follows. So for income tax purposes, £7,000, capital gains £5,000. Now remember, we don't make payments on account for capital gains tax. We assume capital gains tax is a one-off, these gains are a one-off, and if you're making continuous gains, then the revenue are always going to question whether or not you're actually trading. So capital gains tax we pay in full, we don't make any advance payments. Now income tax, so this is where we're going to make that balancing payment of £7,000, but what we're also going to have to do towards 2012-13 is we're going to take that £7,000 and we're going to have to take 50%, and these will become our payment on account for the next tax year. Now if I just add that on to my little timeline, so what we would do is pay $3,500 on the 31st of Jan 13. Now they haven't asked us for that, but just to hopefully help you see where it all falls together. And then what they have asked for, so it is relevant, is $3,500, which would also need to be paid on the 31st of July 13. Okay, so that's our first load of payments on account sorted. Now what we also have is tax liabilities for the year to the 5th of April 13. So again, if we just have a look at the tax year, this time round we're looking at the 12-13 tax year. Now what we've got to remember is we've already just paid 2 lots of £3,500 towards this tax payable figure. So where we've got £35,000, that's the figure that showed as due for the whole of the tax year. Now we've actually been paying tax as we go along. So we've paid £25,000 already, which means if we take these two figures and I deduct my tax collected at source, I have 10,000 tax payable, tax due. Now, one thing just to be aware of is, of course, payments on account aren't always necessarily due. What we're always looking for when we consider payments on account is the 80% rule and the £1,000 rule. So as long as the revenue have received at least 80% of my tax at source, they're happy and they don't require me to make payments on account. So if I'm employed and I'm self-employed, as long as out of the whole of my tax amount that's due, I'm paying at least 80% at source, the revenue do not expect these payments on account. Now let's say I didn't meet that test, so I do actually need to pay some over. If my payments on account, the amount that it's based on, is actually less than £1,000, that's small fry to the revenue, they're not worried about it. Okay, so if it's calculated that your payments on account would be under £500 each, so the £1,000 to start off with, then again you don't have to make these payments. Now if we have a look at how much tax was collected at source here, so if we've collected 25,000 out of the 35,000, that's 71,000. That's not good enough, so payments on account are definitely due. It's always something just to consider. So we're going to have to pay that tax due. However, what we also need to take into consideration is we've already paid 7,000 in payments on account. So that's going to bring us down to £3,000 that's due. And then, of course, we've got the 8,000 that we never pay in payments on account. So I actually have 11,000 balancing payments. So my balancing payment is 3,000 for income tax, 8,000 for CGT. Not that we really worry about the split, but we're looking at £11,000 balancing payments. Now, what we also need to consider, as shown on my little timeline, is the payments on account. So what I'm going back down to here is the 10,000. So considering what I was left to pay, excluding capital gains tax, I would have had to pay £10,000. Now remember, the payment on account isn't tax deducted at source, it's an advance payment of tax. So we're not taking this into consideration here. So when we come to do our payment on account counts, we're looking at what was left over, and again, we're taking 50%, so we've got to pay £5,000 as a payment on account, and that's in advance for the 13-14 tax year. So in total we would have £16,000, that would be your answer, but they would expect you to show all of your workings here, very important, so if you do slip up they can see that you have the right idea. Remember, no payments on account on capital gains tax, and when we're looking at the income tax, any tax deducted of source comes off first, then you consider your 80% test, your £1,000 test, and then when we come to work out our payments on account, we're excluding any payments on account that have been paid on behalf of that year. Right, so that was the final short form question. So what I would like to do now is just go into the second part of the exam and have a look at a couple of the long form questions. Now if we just turn to question number 1, which was on Sam Ryan. Now again, as we've seen with the short form questions, always have a look at your requirement before you start reading through. Now obviously in your pre-reading time before the exam, you can annotate these questions. So what we'll do as we read through it for the first time, we'll make some notes of the kind of things we should be jotting down. So let's start by looking at our requirements. Now we can see this question in particular, although it's a 20-mark question, it's actually split into 2 parts. And they're 2 separate parts. So we're going to start with part 1, where we are required to show our computation of Sam's net assessable income and resulting tax payment due for 2012-13. Now, if we're going all the way down to tax due, we are going to be taking off tax deducted at source. Okay, we want to show our full workings, use our performers. So let's start at the beginning and just work through together the kind of things you should be considering as you read through the different paragraphs. Now, I do appreciate that sometimes a long question can look quite scary. Let's deal with it paragraph by paragraph. Let's treat it as perhaps short form questions that we're just going to pull together at the end. So we've got Sam Ryan is 55. Now, 55, does that mean anything to us? Well, as we've just been discussing, once you're 65 or above, you are considered for that personal age allowance. So as long as your income isn't a lot higher than that reasonable amount of $25,400, you should get a higher personal age allowance. However, not applicable here because Sam is only 55. Now, the other thing we should be considering for paper 1 is national insurance, because of course, once you are above 65, if you're a guy, then you will not have to make national insurance contributions. Generally 60 for ladies, although we're generally told they're in their 70s. So the main thing they're trying to point towards there with NIC is just look out for the pensionable age. So once you're above that, remember the employee doesn't make contributions. However, the employer still does have to make those contributions. Now again, wasn't applicable here. I'm just thinking worst case scenario. Now, we're told he's a managing director of Ryan Security Limited. The company trades as security consultants. He and his 2 brothers each have a third of the share capital. Now, this is something that perhaps you would pick up on, excuse me, perhaps not. But if we do have 3 individuals owning a company, this is what we would call a close company. Now, there's obviously a fine line between what we need to understand for paper 1. So for paper 1, remember, you're looking for a company that is controlled by 5 or fewer shareholders. And the implications that we generally see here, one of them, as we'll see, is to do with qualifying loan interest. So one reason that closed companies, alarm bells will go off for us on paper 1, is because if you take a loan out to invest in a closed company, you've actually got your qualifying loan interest. Okay, and we'll see how that's dealt with later on. Now, the other thing is people that take things out of closed companies, how they're taxed on those. We won't be covering that in this session, unfortunately. So that's what I need to think when I see that line there. Now, I then go on to the second paragraph, and I'm told that Sam receives remuneration of $125,000. So that's going to go in my non-savings column. He's also got PAYE deducted of £50,950. So that's what I'm going to deduct in my tax paid at source. We're told that he uses his own car for business miles, and we're told how many miles he's actually done. Well, remember, alarm bells should go off when you read that somebody's using their own car for business mileage, because we've got the mileage allowance. And again, your tax tables can help you with those. At the bottom of page 1, you do, of course, have the rates for the cars, the vans, the motorcycles, the bicycles. We'll talk about those when we get to actually putting our answer together. Now, the next paragraph is telling us that Sam and his family live in a house owned by the company. They pay rent of £750 per month. Now, just be careful. This is the family. So Sam and his family are paying this rent. It's not the company. So just make sure you read it the right way round. And, of course, what this is actually showing is an employee contribution. So when we come to working out our living accommodation benefit, we're going to be deducting this rent that's been paid because it's the employee contribution. Now we're told the house was purchased in March 2000 for $300,000. Now again, I'm looking for a figure that's above 75, because if we're above 75, we're going to have this additional charge. And we're told it's got an annual value of £2,500. Now, if you just think back, what we have for living accommodation, we have the basic charge, which is where we compare the annual value and the rent paid by the employer. Well, if the house is purchased by the employer, they won't be paying rent for it. So generally, you may just see one or the other. So the basic charge in this case will be that annual value of $2,500. And then we have the additional charge, because the house costs more than $75,000, we're going to have that extra charge to calculate. And remember, we have that 6-year rule. Now, what we're told here to help us with that 6-year rule is the house was purchased in 2000 for $300,000. He's moved in March 2009 when it's worth $750,000. So what they're looking for here is for you to recognise that he's moved in more than 6 years after it was bought by the company, and therefore you're going to use the market value rather than the cost. Now, one other important point to note here, the additional charge is only applicable if your employer has bought the property. So if they're renting a property on your behalf and it costs more than $75,000, it doesn't matter. So the chances are the employer will have bought the property, because then you have to consider this additional charge. So we've got our basic charge, we've got our additional charge, we've got employee contributions that we're going to have to deduct once we've calculated our benefits, and then we have the company that are paying expenses on behalf of the individual. So they're paying the council tax, the water, the insurance, the cleaning and the gardening. Now the insurance is something that we would always expect the landlord to pay, so that is not going to be taxable. However, the other costs will be. So out of those there, we will have to pay tax on the $1,500, the $500 and the $2,250. Those are all going to be taxable, just like if I walked into the office tomorrow and I complained about my electricity bill, if Tolley said we'll pay that for you, then that's just going to be extra earnings for me. I will be taxed on that. Now, one point just to note, and again, perhaps they could have made this question a bit worse, because job-related accommodation does, of course, have a different set of rules. Job-related accommodation, we don't have the taxable benefit in terms of the basic and the additional charge, but we have that 10% restriction when you look at bills that are paid on behalf of the individual. So if you are thinking, I'm sure there was a restriction, yes, you're right, but that's purely for job-related accommodation, and that's where they actually have a limit on what they can be taxed on in terms of these charges. Now, the next paragraph we've already talked about. So he takes out a bank loan to purchase the shares in the company, and he's paying interest of £8,500. Now, as we've actually already spotted, this was a closed company. So what we have here is qualifying loan interest. So that's going to fit into our pro forma as a deductible payment. Now, if you're unsure, qualifying loan interest, those are all listed in section 388 of the Income Tax Act 07. So if you go to section 388, it's from that point onwards, it lists out all the different types of qualifying loan interest. Okay, so those are the ones where if you buy into a partnership, again, the interest that you're actually incurring is a deductible payment for tax purposes, so it's going to reduce your taxable income. Now, the next little sentence here talks about him making a gift aid donation of £3,900 to charity. So again, how are we going to deal with this gift aid donation? Well, we're going to gross it up, and of course this will extend the basic rate band. Now, that could have said perhaps he makes a personal pension contribution. It would be exactly the same treatment. So we're extending the basic rate band, and again, we'll show that when we run through how the tax liability is calculated. Now, just be careful if it's a payment under payroll giving, or perhaps they were giving into an occupational pension. They're the ones where we don't extend the basic rate band, but instead we actually reduce our employment income. So just remember, extending the basic rate band is specifically for gift aid donations and personal pension, and they're treated exactly the same. And then the very final paragraph we have here is that Sam had some dividend income. So dividends will go in their own column, and of course, we will gross those up by 100 over 90. So we'd have 20,000 going in. Now, what I've done here is I have put obviously quite a lot of information on the question. You just need to make sure that if it's relevant, it goes in your answer sheet. But these are the kind of things I would be looking at as I'm reading through the question for the first time. So I'm reminding myself of where these things are going to go. And then when I come to actually write up my answer, little things like extending the basic rate band, grossing it up by 100 over 80, make sure you show those in full so the marker can see exactly where all your numbers have come from. So let's just have a look at how I've actually pieced this together. So for question number 1, what I've tried to do here is show you it by using different colours. Now, as I've read through the question, I've started off with my purple pen and I've set up the types of income that I was expecting Sam to receive. So I've read through the question and I can see that he's got employment income. I can see at the end there he had some dividends. Now the dividends I can put in straight away. The employment income, unfortunately I can't. I'm going to have to go off and do a calculation to show where my number comes from. But as always, I will show the marker where I've done that by labelling it up with the working. Now also, as I read through the question, I spotted the qualifying loan interest. So that, of course, is my deductible payment. So again, that's gone in my pro forma. And that, if you remember, is the difference between your total income and your net income. So in terms of employment income, non-savings, my total would be the 149,250, but then the difference from total to net is purely any deductible payments. Now, qualifying loan interest is an example of a deductible payment. We could have also perhaps had a gift of quoted shares or a gift of land, and that's when, of course, we put the market value in there, and again, it just acts as a deductible payment. Now, I then get down to my personal allowance, and I wouldn't have known, until I'd actually calculated my employment income, I wouldn't have known what my personal allowance would have been. So we'll come back to that in a second. Now, let's just see how my employment income was actually calculated. So as I read through the question, I put in the salary. Now, the mileage allowance and the accommodation, I haven't been able to do off the top of my head. I have had to go off and do another working. So again, I've shown this by labelling them up separately to show my marker where they can find these answers. Now, if we have a look at the mileage allowance first, we can use page 1 of our tax tables, and we're basically looking at what has he received and what was he allowed according to the mileage allowance rates. Now, he has received £5,250 because he's got his 35 pence for each of the miles. But as per our tax tables, he's only allowed 45p for the first 10,000 and 25p for the remaining 5,000. Now, he's actually received 5,250. He should have, or he was able to receive up to 5,750. So the difference that we have there is actually an allowable deduction. So this figure here is going to go into our employment income as an allowable deduction. Now, one thing just to bear in mind, let's say that actually he did receive more than what he was allowed. That, of course, would have become taxable, but not necessarily nickable. So although this question didn't require you to consider the national insurance, just remember with mileage allowances, for national insurance purposes, they only nick you on the excess above the 45 pence. So So although here we know that some of these miles he was only allowed 25p from a tax-exempt perspective, for national insurance purposes, he was still below the 45p. So there would never have been an NIC liability, even though there could have perhaps been a tax one, depending on what he'd received. So my 500 here, that's then going to go in and deduct from my salary. So it's just going in as part of my employment income, but rather than being income, it's an allowable deduction. Now my accommodation, we talked this through as we read through it in the questions. So my basic charge there is that annual value. There is no comparison in terms of the rent paid by the employer because that wasn't applicable. And then my additional charge, I'm looking at the excess above the 75,000 times by the official rate of interest. And I'm not using the cost that they've given because he's moved in more than 6 years after they actually bought the property. Now, just be careful. Right at the beginning, we were told they'd paid £750 per month. So that's my employee contribution. And then also, as we discussed, there were those expenses that were paid on his behalf. So we're going to pay tax on all of those apart from the insurance. And again, don't just ignore the insurance. Make a note to tell the marker why you haven't done anything with it. Okay, because you're bound to get credit for that. So like ISA interest, if somebody has ISA interest, we don't just ignore it. We'd always put a little note in to say it's exempt. And then they know that we've treated it in the right way. Okay, so those are my workings. So what I would then do is pull all of that back, and then I can actually get into working out some tax once I've got those numbers in my pro forma. So my 149,250 goes in. Then I can run it through. Now at this point, we recognise that we are well and truly above that £116,210 because remember, once you're above £100,000, you're going to lose your personal allowance. So for the amount that you are above the 100,000, just like we saw for the personal age allowance, 50% of the excess is then going to reduce your personal allowance down. Now, one thing just to consider here, it wouldn't be as straightforward as saying, well, his income's 160,750. Do remember it's based on net adjusted income, so we would also take into consideration any gross gift aid or personal pension contributions. So those would always be deducted in terms of looking at what our net adjusted income is. However, in this case, we are still way above that 116,210. So once we're above that, if we take our excess, we divide it by 2, we're easily going to wipe out the whole of the £8,105 personal allowance. So that's why I don't have a personal allowance here. If it's obvious, if it's numbers that are very big, then that should be sufficient. If in doubt, show your full workings. Now we're then able to take our figure from our non-savings column, run it through the tax band. So again, my tax tables can help me here. The first £34,370 is going to be at 20%. And then I'm looking at my gross gift aid donation, so £4,875. That's also at 20% because I'm just making that band larger. Now, the remaining amount from my non-savings column is then going to fall into my 40% band, where, of course, I'm able to tax £115,630. Now, some confusion is caused where people extend the basic rate band. So when we're extending our basic rate band, the way I like to think of it is it does mean the gross gift aid or the gross personal pension contributions. That's the extra bit that I can then tax at 20%, but we don't then increase the gap for the higher rate. So we would always then go on and always only tax $115,650 at the 40%. So after I tax my non-savings income, I'm actually left with a gap in my higher rate band. So when I come to tax my dividends, I'm then taxing my dividends at the 32.5% until I fill up that 40 or 32.5% higher rate band. And it does mean that some of my dividends there are going to fall into the additional rate and be taxed at 42.5%. So I've run those numbers through my tax band. That brings me down to my tax liability. I didn't have any tax reducers to consider here. And then finally, to get down to our tax due figure, we're going to deduct our dividend tax credit and we're going to deduct our PAYE. So what looked like we owed £55,539, we actually have paid an awful lot at source, so we're only going to have to pay over that 2589. And that's our tax due figure. So all of that was worth 10 marks, but there was lots of nice twists in there, and as we discussed as we looked through, it could have perhaps been a bit worse. Okay, now that was part one of question one. If we just have a very quick look going back to the question, the second part of this question for 10 marks was asking you to write a letter to Sam, and he had specific questions that he wanted explaining in terms of a property for income tax and capital gains tax. Now, I'm not proposing to go through that one. In terms of questions like that, just remember to consider all different aspects. If you feel it's relevant, jot it down. It could be worth some marks. So those of you that haven't had a chance to look through the solution, have a look through the solution. But as always, if you are practicing questions, always attempt the written ones. Don't just read through the answer and think, oh yeah, I would have got that and I would have got that. Until you're in that situation, you don't know what you will actually think of. So it's always good to have a bit of a brainstorm on these written questions to make sure that you would have come up with the points. And a lot of people miss the obvious ones. Okay, so we always say state the obvious there. Now, the final question I'm just going to run through before we finish this debrief is question number 2 in the long form questions, which is again a 20 marker on Sally. Now, what we need to do with Sally is, again, have a look at the requirements first of all to see what we're going to be calculating. So for 17 marks, we're told to show your computation for capital gains tax payable, assuming all beneficial claims for relief are made. Now, the second part of the question explains the capital gains consequences of Rao gifting the necklace to Sally before they marry or after they marry. So a nice 3-mark question, purely to do with the rules in terms of once you're married, what type of transfers do you have, and how would that be affected if you gifted before you marry. So let's start with this 17 marks first. Now again, I'm just going to run through the question as you would in your pre-exam reading time, just to see the types of things we should be looking out for. So let's have a look at disposal 1. We have on the 31st of December 2012, Sally has sold 20,000 shares in Multi-Group PLC, a 3% holding for £195,250. She'd bought them for $15,098, and there had been a rights issue. Now, 2 things to think about here. We have got shares, so we need to consider the share rules, and we'll see this a lot in this question. So remember, whenever you're considering shares, you're looking at were there any sold on the same day or the next 30 days or in the Section 104 pool. So basically, any that actually you acquired before the actual date of sale, those will be treated as in the Section 104 pool. And in disposal number 1, we're purely going to look at this Section 104 pool. So she didn't buy any on the same day that she disposed of them. She hasn't bought any in the next 30 days. So all of these shares are going to come from the Section 104 pool, which we will have to put together. Now, we'll see this as we go through the answer. And we're going to look at 2 columns, so the number of shares and the cost. And of course, if we have a rights issue, it just means we're going to have money to spend on these new shares, as opposed to if there was a bonus issue where the shares are actually for free. Now, the second disposal was a painting. So she sold a painting, $7,100, incurred cost of sale, and the painting was purchased for $2,000. Now, this is where alarm bells should go off because we have a value of less than £6,000. Can we touch the item? Is it a chattel? Yes, it is. So we've got the chattel rules here. So remember, if you either have proceeds or costs of less than 6,000, you've got one of those rules to consider in terms of, are you going to restrict your gain or are you going to restrict your loss? So we need to here consider those chattel rules, and we'll come back to those. Now, something else to consider, and I did actually say in the first part 2 things, and I only talked about one, is the release. Now, a lot of people, when they see shares and they see that they're quoted or they're unquoted or we're given shareholdings, will think about entrepreneur's relief. Now, entrepreneur's relief isn't something to consider for paper 1. So for those of you that are studying paper 2, don't consider entrepreneur's relief for paper 1. It is not on the syllabus. Now, the other relief that people like to consider is gift relief. Remember, gift relief is only going to be applicable if you actually dispose of a business asset. So if we're giving away things, it's got to be a business asset for us to get gift relief. Now, again, that wasn't applicable in this question. Okay, so the 2 reliefs that people often consider with shares are not going to be relevant here. Now, the third item that was disposed of was more shares. So again, not entrepreneur's relief. We don't have to worry about that here. And if we just think back to those rules that we were talking about, did she acquire any on the same day? No, but she has actually purchased some more shares in the next 30 days. So in terms of those 3 different rules we need to consider, same day, next 30 days, section 104 pool, yes, she has bought some in the next 30 days. Now what that means is she's acquired some in the section 104 pool, some in the next 30 days, so we're going to have 2 disposals to consider. So when we come to do our calcs, we'll have a disposal for the next 30 days, and we'll have a disposal for the section 104 pool. Item number 4, she sold her flat. So when we think about properties, we should be considering principal private residence relief, PPR, but of course we have to have lived in a property at some point in time for us to qualify for PPR. Now, she bought the flat and she'd always lived there, so as soon as we see the fact she's always lived there, then we can be considering PPR. What we would also need to consider is, of course, if she's lived there and she's let it out, then that is an extension to PPR, and we can then consider lettings relief as well. Now, we've got the key numbers here. So we've got the proceeds, we've got the costs, and then we've got what's happened during the time period. So what we'll do when we come to look through the answer is I'll show you how it's all working on a timeline. But just what I want to mention here is, remember, PPR is only applicable if you've lived in the property at some point in time, and then lettings relief is only applicable if you've got PPR relief. So I can't buy a property and let it out. I won't get lettings relief. I have to actually get the PPR relief, and then it's kind of a knock-on, an additional relief as part of the PPR relief. Now, we also had an item number 5, which was selling land. So sold 2 acres of land when actually she originally acquired 10 acres. So this is going back to a lovely part disposal calc, and we've already seen those when we touched on the leases in the short form questions. So again, we're going to set this up where we have a nice diagonal going through to show us how these calcs work. Couple of things just to finish off. She had capital losses brought forward. Her taxable income is $140,000. That is telling you to tax at 28% because, of course, as per our tax tables, it does remind us there is an 18% tax rate for capital gains tax, but that's only if you're a basic rate taxpayer. And if that then moved you into the higher rate band, you'd end up taxing at 18% and 28%. So by telling you it's $140,000, you know that it's all going to be taxable at 28%. Now, she's made a qualifying investment in a seed enterprise investment scheme of $20,000. So again, that's a deduction we can have. And then the final part talks about the second part of the requirement, which is basically, does he give her a necklace before they marry or after they marry? We'll come back to that bit at the end. Okay, so let's have a look at my answer. So if I just scroll through, let's find question number 2. Right, so the first thing I've actually done here is, again, just to show you my thought process, when I've read through the question, I've identified the types of assets that we're going to be disposing. So I've gone through and I said we're going to dispose of some multi-group PLC shares. So those have gone in. We're going to dispose of a painting. I've listed the painting. The Friday PLC shares, I've listed those. The flat, the land, those are all listed down. And what I've recognised is I can't just come up with a figure. So I've actually put a working next to each of those to show the marker where they can actually find all of my workings. Now, once I've done those workings, I've then gone back, put those in. So I've shown in green that I've had to go off, do the work and pull them back through. And then I can deduct that SEIS reinvestment relief, which will always sit before losses. Losses brought forward, remember, you always deduct your losses brought forward. However, if your gains were quite low, you could have preserved your annual exemption. Now, it wasn't applicable here, so we can just deduct the 40,000 loss brought forward in full. And if we had had a current year loss, that would have gone before our losses brought forward. Now, as always, you're going to pick up easy marks for deducting an annual exemption. And then, of course, we knew that we were going to be taxing at 28%. Now, what I want to show you here is, of course, I can pick up easy marks just by making sure I deduct the Seed Enterprise Investment Scheme relief from a figure, the losses brought forward from a figure, to make sure I'm showing that I know to deduct the annual exemption, and I end up taxing something at 28%. So often, the easy marks are right at the end. You just need to make sure you've got some numbers in there to get that far to actually show that you know how to tax. So if we just go through each of the assets one by one, so the first thing I had workings for was the multi-group PLC shares. Now, in order for me to calculate my costs, I needed to draw up my Section 104 pool. So I'm just showing exactly what's happened. In December 98, I bought the 15,000 shares. They cost me £15,000. Now, in July 2002, there's a rights issue. We were told in the question it was 1 for every 3 that was held. That means we're going to get 5,000 extra shares, but we were also told they cost £3.25 each. Now, the important thing to note here with shares is we don't care about how they were actually put together in terms of cost. We're just putting them all in one pot, and then we're just treating the cost as an average cost per share. So I don't care that some of them were more expensive than others. As far as I'm concerned, I've got 20,000 shares. They cost me a total of $31,250, and I don't care that some are actually more expensive than others. Now, we are actually selling all of the shares here. So we did only have 20,000. We're selling all of them. There were no shares bought on the same day or the next 30 days. So we can literally just do that one disposal with the full cost of £31,250. So hopefully that's a reasonably nice share question. One disposal, and we're not apportioning our costs at the end because we're disposing of all of them. Now, we will see this with some changes in a second with the other share disposals. The other thing to note is I haven't done anything with indexation allowance because, remember, indexation allowance is not applicable for individuals. It's purely for companies. So we should not be considering it when we're doing paper 1. So my gain there of 164,000 goes back into my pro forma. Now, the second asset that we had was the painting. Now, we did mention as we read through the question that the painting had a cost of £2,000, which was less than £6,000, which means we have the chattel rules. Now, if you do have proceeds of above £6,000 and cost of below £6,000, remember you need to do 2 calculations. So we don't just go and use the 5/3 rule. That is a rule that we need to use, but we also need to do a normal gain disposal as well. So there's a sale of the painting for $7,100. Cost of sale we get to deduct, so this is just the normal straightforward gain calc, and then we're disposing of our asset, which was the cost of £2,000. Now that means we get the gain of $4,600 under the normal rules. Now, as you can see here, because of the chattel rules, I will also do the special rule where we take 5/3 of the excess proceeds above £6,000. Now, the trick here is obviously the net proceeds was $6,600, but whenever we do this, we always use gross proceeds. So it's the $7,100 I'm putting in, deducting the $6,000, and I'm timesing by the 5/3. Now I need to do both of these calculations so I can then show I'm doing a comparison, and we always take the lower of the two, which is why I've pulled the £1,833 back into my pro forma. Okay, so the chattel rules, don't miss out on easy marks by just doing the 5/3 rule. It's got to be both and then take the lower of the two. Now the third disposal was more shares. Now it's always worth putting a little note there when you're making share disposals as to have you considered the same day, the next 30 days in the Section 104 pool. So I've put a note there to show I have considered them. I meet 2 out of the 3, and then I've shown the split of which ones I'm disposing of from which of these areas. So have I bought any on the same day? No. Did I buy any in the next 30 days? Yes. So those are the ones I'm going to be deemed to be disposing of first. Have I disposed of any in the Section 104 pool? Yes, because that's my final place to go to. That's where I dispose of the remaining amount, which in this case is the $5,000. So let's have a look at how the Section 104 pool would have come together. Now, the only acquisition I had was 25,000 shares in 1988. And because I'm then going to dispose of 5,000 shares out of there, I'm just looking at the average cost per share. So I'm basically taking my 20,000, I'm dividing by the 25,000 shares it represents, and then timesing by the 5 shares that I need to dispose of. That means my cost for those 5,000 is going to be £4,000. So I've done my hard work ready for when I do my gain calculations for each of these 2 disposals. Now the shares that I'm disposing of in the next 30 days, that's a bit more straightforward because I'm just given a straightforward cost, so I didn't have to worry about creating my Section 104 pool. So in terms of the proceeds, I do need to split the proceeds to show these as 2 separate disposals. So I've got my 16,000 going in. That's the proceeds, so half of them. So if I'm selling 10,000 for 32,000, 5 of them were for the next 30 days. Then I've got proceeds of 16,000 and I've got the cost of 15. Now, if you're still confused about why we do this, remember the whole bed and breakfasting rules. I would recommend you go back to your course manual and just have a read through the rules. As always, if you have any questions on anything that I'm running through here, do get in contact. You've obviously got the forums on the Academy and you've got our normal exam training email address. Okay, so if there's anything that's still not quite there, do drop us an email. So that's my first disposal, proceeds less the cost. Now the Section 104 pool gain, again, same amount of proceeds because I was disposing of 5,000 from the next 30 days, 5,000 from the pool. And I've done the hard work because I've already calculated that 4,000. So what I perhaps would do in the exam is put a little note as to where I got this from. So it might be on working number 7. So I go back. That would then be my working 7. And then they can see exactly where that 4,000 come from. Now the fourth item was the flat that's sold. And as promised, I've drawn a little timeline to represent the time that this asset was owned. So it was bought on the 1st of July 1999. Sally lived there for the whole of the time apart from the 1st of January 2003 until the end of December 2007. Now it was let in this period, and before you actually cancel that all out and say it was let, remember we do have deemed occupation. So So there's periods of time where we're allowed to pretend we were living there, even if that was not the case. So obviously if you're living there, that's absolutely fine. The last 3 years will always count. And if you've ever been in the property before, left the property and returned to it, we can always deem 3 years as being deemed occupied. Now there are those special rules in terms of where you send to board by your employer. If that's the case, as long as again you lived in it before and returned to it afterwards, you can count that period, or 4 years if you're actually in the UK. But that deemed occupation, the 3-year rule, we've got that 3 years any reason. So even though she's actually living with her boyfriend, we can still treat the 3 years any other reason. So out of that 5 years where it's let, 3 will still count because it was returned to, and 2 years therefore doesn't for PPR purposes. Now, as we discussed when we looked at this question originally, if you don't get PPR for the full period, but you did have some periods where it was let, you're looking at lettings relief as well. So let's just have a look at these calcs. So I've got my nice gain calculation, proceeds, my sales costs, brings me down to my net proceeds. I can then deduct my acquisition costs, get to my gain, and as always, if there is any applicable capital gains tax relief, it's always based on my gain figure. Now the PPR relief is £232,481. The way I've calculated that PPR relief is I've actually taken my gain, so my gain being the £274,750, and when we looked at the amount of time, we had 11 years that we were deemed to occupy the property out of the 13 years it was owned. So my PPR relief is going to be that £232,481. Now in terms of lettings relief, what we need to make sure we show is we're considering the lower of 3 different amounts. You've got your PPR relief, so we've just calculated that as 232,481. You've got your let period. Now the let period here would be 2 out of the 13 years times by my gain. So that actually equates to 42,269. Or the other thing we always have to compare to is 40,000, because that is the absolute maximum you're ever allowed to deduct under lettings relief. And if we just compare these numbers, that is of course the lower of the 3, which is why our lettings relief is 40,000. Now it does leave us with that little gain of £2,269, so that then goes through into our pro forma, and that is how much we're going to be taxed on for the flat. So not bad considering. Now the 5th item was the disposal of land, and as we saw earlier with the leases, the hardest point here is actually getting your proceeds in. So it's just making sure that if you are disposing of part of your assets, you're not going to apportion the cost by the number. We see that with shares, but not for any other assets. So the 50,000 goes in and it goes through the diagonal. So this is exactly what we saw earlier for the leases. The leases did have that extra little bit in terms of making sure the full premium was on the bottom, but that's not applicable here for the land. So it's a nice, straightforward, what we have as proceeds just goes all the way through. So we're apportioning our cost of 25,000, and it means that out of that cost, we're not going to use it all. We're going to be leaving some behind for when they'd actually dispose of the remaining 8 acres later on. Okay, so that's all of my disposals. That's my full workings. And again, if it helps, work through them one by one, treat them as short form questions, and then of course, just make sure at the end, you bring all of your hard work back into the pro forma, so all of those numbers will come through as we've discussed, and then make sure you finish off by actually calculating some tax. Now the very final part of that question, if we just go down, was talking about the CGT implications of gifting the necklace before they marry or afterwards. So the necklace that we've been told about is worth 40,000 when it was given originally from his grandmother, and it's now worth 57,000. Now what this wanted you to recognise is once you're married, of course, you are spouses, and it would be a no gain, no loss, and your original your original cost for that person, so the original 40,000 would have then been transferred through, so that Sally would get the actual necklace at no gain, no loss, and then the cost going forward for Sally would have been 40,000. Now that's if they're married. Now if the gift goes through before they're married, we've just got a normal disposal. So we'd have a normal disposal, which would be our market value being the proceeds, so 57. Then we'd have that cost of 40. So we would actually end up with a gain of 17. So before they marry, a 17,000 capital gain, 57,000 would become Sally's base cost. But if they wait until they're married, no capital gains tax because it's no gain, no loss, and the 40,000 would become Sally's base cost. So that's what they wanted you to do for those 3 marks. Just think about a difference in timing in terms of marriage or before marriage. Okay, so that was another 20-mark question on CGT. The final long-form question on this paper was a nice letter for income tax and national insurance implications. So if you haven't worked through that fully, I would recommend you do so if you've got access to this paper. Again, remember with the written questions, just don't assume that you'll get the points. Actually attempt the question to make sure you're comfortable with all of them. Okay, so that concludes this session. I hope you found it useful. As always, any questions at all, like I say, use the forums on the Academy or drop us an email at exam training. Good luck for your exams. Just keep calm, and like I say, with these long form questions, deal with them bit by bit, but pull it all together and make sure you do actually answer the question and you do calculate tax on a figure. Hope it goes well. Thank you.